Hey, everybody. I'm going to try something new, I think. Yes, I got volume, which is great. I'm going to try something a little new today. Normally I do like 8 questions. I'm going to try 12 because, I don't know, I select 8 from the community on those top questions, but they were so interesting and I learn so much generating the answers. So big thank you to everybody out there that brought in the questions. So we're going to talk about Blackrock billions, what it means, can it fuel a Bitcoin surge? Is it different this time? Will it amplify the hardness? We'll dig into that. We're going to talk about very interesting pair trading concept, pair trading between gold and Bitcoin. Wow. See if that works, see if we can do it, see if we got the tools. We're going to talk about deflation versus store of value, basically Bitcoin versus ETH, ETH versus Bitcoin. At what stage would I flip my thesis, my 80-20 to being 20-80. Interesting one too. Mixing services and blacklisting. Tesla's future. Tesla to infinity. Tesla options. Options trading. We're going to talk about, what else? A bunch more. Oh yeah, an interesting one. Somebody asked me a question. How much does GDP need to grow to get debt levels in the United States down to 0? That was a mind expander. So lots of good questions. We're also going to talk about real estate modeling. Does it make sense to wait for rates to come down to buy? The answer will surprise you. So let's jump in. And of course, this is not financial advice. Just some guy on the internet sharing his edutainment. And where to ask questions, these all come from Patreon community. And there'll be a link below. Patreon.com/InvestAnswers. The amazing team, amazing community, extremely active. And lots of learnings there too. And if you want to amplify your intelligence, please subscribe to the channel. Very important time to be smarter than the rest. If you're listening to the herd, if you're following the herd, you're not going to make it. And that's just the reality of the crazy world in which we live in. So first question is from Fib108. I like that. If Blackrock comes in with billions, is it likely the price of Bitcoin will become more stable and less likely to crash as in previous cycles? It has been stated that 0.3% of our funds under management, of their funds under management should be, would suck up all available Bitcoin on exchanges, and going forward, they'll be able to buy all available at the next all-time high when lots of people will inevitably sell. So we're going to touch on this a few times today, but of course every asset has its price. For every buyer, there's always a seller and vice versa. But let's dig into this and let's talk about what I call hardness amplified. I always talk about Bitcoin being the hardest asset. Well, it's just about to get a whole lot harder. This is incredible. Kiwi, you're too much. But here you can see the supply of Bitcoin has been declining for the first time in its history. You've heard my thesis about 14 million max coins because so much is lost, Satoshi lockup, etc. People are losing their coins every single day. Even trusted custodians with the name like Crime Plus, Prime Trust, whatever, in their names, they lose the keys. So it's like the pros are losing them as well. So that's why I say never more than 14 million Bitcoin. And that is kind of sad, but that's okay. Because as Satoshi said, every time somebody loses Bitcoin, it's a gift for people that have it. Anyway, this decline supply is likely to lead to a massive bull run in the future. I don't know if it's this bull run we're currently in or the next, but it's coming. That I'm certain of. This is because there is more demand every single day for Bitcoin and the supply is drying up. And that means price goes up. That means the pace of hardness is increasing and the institutions are here. BlackRock, Fidelity, Deutsche Bank, Credit Agricole, Citadel, you name it. They're all coming and probably hundreds more. And even these few names run AUM of $27 trillion. The market cap of Bitcoin is $500 billion. It's ridiculous. And only a tiny fraction of that $500 billion of market cap is for sale. So you guys can do the math. It's the most beautiful macro and economic experiment I've ever seen in my life. And I just get excited every day to look at the data. Anyway, the point of this chart here is you can see the available holder supply as a percentage of total supply. And marked in black dots are the actual halving cycles. This is the first time ever in a halving cycle where the supply is going down before we're even in it, ladies and gentlemen. And that is exciting as hell. So I encourage you all stay healthy because the next 8 years will be fantastic. Now, let's talk about the Blackrock allocation impact on Bitcoin price. I've covered this a few times before. But even if they allocate half of 1% of their assets under management, and we're just talking one firm with their Blackrock ETF, and I know their Aladdin system will tell people to allocate at least 1 to 2, maybe 5%, price will go insane. There is an arms race on now for the big money banks to get into this thing. Even the IMF flipped yesterday. I covered that in yesterday's video. Now, there is a piece that everybody's very, very concerned about, and that is this. Market manipulation. We know the big boys, the BlackRocks, JP Morgans, they play funny games out there. And I'm not casting any aspersions, just pulling up ancient history and everything else. But this is because of naked short selling. Now, this doesn't mean you sell stuff short without any clothes on. This means you sell it without owning the actual financial instrument. And this chart basically shows you how, people that can have, futures contracts or options. In fact, Bitcoin's coming out with a new futures contract on Tuesday. You can actually technically play with the asset without owning or borrowing the underlying asset. And critics argue that large financial institutions can engage in excess of short selling like they've done with gold and silver for decades, creating an oversupply in paper contracts in the market. And this oversupply exerts downward pressure on prices, potentially benefiting the institutions and their trading. So a simple example of this, the gold market, the paper gold market is 130 times larger than the spot gold market, 130 times more paper. But one of the saving graces that BlackRock did, because one of the concerns that the SEC had was market manipulation. So that BlackRock are working with NASDAQ to monitor all trades and manipulations. So maybe, hopefully to prevent this. But at the same time, the SEC is approving lots of Bitcoin futures, even leverage futures. So with that, net, it's a positive for the space. Yes, I do believe it'll stabilize the price to a large extent. When retail sells, we've seen the whales buy time and time again this year. People know what's up. And I feel sorry for those that are selling this asset, because a lot of people, after, this is typical behavior too, a little bit of psychology here. After what we've been through in 2022, people are actually almost too fast to take profits. Oh, I'm up 85%. Take it off the table. Buy back in lower. I've experienced many times in my life, you never get a chance to buy back in lower. Yeah, some of the time you can. But with exponential assets, it's a risky maneuver. I'll talk more about that actually later. So next question from Susuhi. Let me pop this up. What do you think about Bitcoin gold pair trading at Bitcoin all-time high? You would have exchanged for 38 ounces of gold. So that is one Bitcoin you would have exchanged for 38 ounces of gold, and that today would be worth $73,625. Not bad for taking profits in gold instead of US dollars. Suggestions? This is very selfish of me, but the reason I work all weekends preparing answers to these questions is because they're brilliant, and I learn from them too. And I did a lot of modeling around this. So let's look at, first of all, a couple of things you need to know about pair trading. And this is the correlation with gold. And according to a study by Keiko, the correlation between Bitcoin and gold is approximately 50%. That means half the time it's correlated, half the time it's not. That means 50% of the time the two assets moved in the same direction, half the time they don't. However, the correlation has been lower in certain periods. For example, the correlation was only 10% in June 2022. So you got to watch the correlation when you're trading these pairs. Second thing that's very important is co-integration. And the reason this is important is everything that is co-integrated reverts around the mean, which means it goes back. And Bitcoin and gold, there was a deep co-integration analysis done by Garcia et al. In 2018. And the paper examined the relationship between Bitcoin and gold using co-integration analysis. And again, it's a statistical technique that tests whether two or more items in a time series are related in the long run. And the authors found that Bitcoin and gold are co-integrated, which means they have a long-term relationship, which means, ta-da, yes, you can pair trade them. So check. Let's look at some charts. Let's look at zooming out Bitcoin and gold. And here you see the whole history. Now, first of all, Bitcoin over the last 6 years has done 6,000% better than gold. That's the first thing you need to realize. Gold has performed really badly over the last 11 years. And in fact, over the last 10 years, it's only gone up 5%. And if you look at the debasement of money, the half-life of money over a decade is basically half. It's a little bit over half right now because of money printing. That means $1,000 10 years from now is worth 500. Gold 10 years ago is only 5% higher. So you're losing your shirt on gold. But there are times when it is possible to do this. So let's look at this. Is the Bitcoin divided by gold chart. Again, it's based in US dollar ounces. In the US, they have this weird measurement. It's prehistoric. I think the dinosaurs used it to carry weight and stuff, ounces and pounds. But that is, the 38 ounce was the top, and that's about 1.1 kilograms of gold per Bitcoin. And now we are trading at around 16, but we went as low as about 9.5. So people are always thinking about, oh, how do I think in terms of pairs? Beautiful example right here. Do you want 1.1 kilos of gold for your Bitcoin, or do you want a tenth of a kilo? Was that 100 grams or something? Yes, I think so. So let's look at the layers by which you can swap. And what we're going to do here is we're going to look at a product and look at the history of the actual pair trading opportunities that we could have. And if you have a big bag of Bitcoin, maybe instead of layering out, as we practice here in this channel, into gold or into cash, you can layer out into gold. So here are some of the layers per the layer out model, which works across, of course, for pairs and everything else, FX, you name it. But here, one of the first layers, we would have taken profit, maybe 20% of our bag or a fifth of our supply or whatever, would be 14 ounces. Second layer, 17 ounces. Third layer, 21 ounces. Fourth layer, 25 ounces. And the fifth and final layer, 28 ounces. And then you're out of the position. But it gets better. Let me show you another little trick that is fantastic. What you can do is also swap between, this is the whole pair trading thing, at layers, telling you when to get in, when to get out. So I put together a little illustration for you. So at the very bottom on the left-hand side of the chart here, this is the layer. It's about 14.2. This is where you sell gold for Bitcoin. You could have done this in April 2022. Then you sell Bitcoin for gold about 3 weeks later. Then you sell gold for Bitcoin about 3 weeks later. Then about 2 weeks later, you sell Bitcoin for gold. And on and on and on and on. So you could have swapped in and out and use the layers and the trend to flip between the assets. Right now, we're in a bit of an exponential run up. The big fat blue line is the kind of the what I call a rampage. So this means hold. You don't swap back until the trend flips. But that's the discipline that we're trying to impart here in this channel. How to pair trade, using layers, using tools, using discipline. And that was a brilliant question. I really was excited about that one. So thank you for that. Who knows? I might even be a gold holder if gold is at the right price and Bitcoin is to the moon. So next question is from Luiso. Deflation versus store value question. If government said tomorrow that they are going to hold Bitcoin and ETH on their balance sheet, what would it take for you to consider to flip the percentages on your portfolio with one for the other? I.e. 85% ETH and 10% Bitcoin. So this is kind of based on my current structure. I'm probably 80 to 81% Bitcoin, depending on the actual price of Bitcoin, about 16% ETH, and about 4% Solana. And I have a tiny, tiny sliver now of a thing called Render. So that's my position. So first of all, there are things to consider. And this is one of the kind of the quicker questions, but just let you inside my head as to how I think about this question. How would I flip the percentage? Well, I'd need to see evidence that ETH is becoming more widely accepted as a store of value. I would also need to see evidence that ETH is becoming more decentralized, because I am a bit concerned about the heavy concentrations with big hosting companies. I would also like to see it take over the bond market. That piece is so critical. How people still buy bonds in this day and age, I don't understand when they know the underlying is debasing like crazy. But there is a play for ETH to take over the bond market, and that market is huge. We're talking hundreds of trillions of dollars. I'd also like a guarantee that it will remain deflationary, because technically Ethereum could increase their supply due to an EIP that could pop out, and we may have no control over it. Also, I'd like to see it work as an effective and efficient payment mechanism for everyday transactions that would drive a lot of adoption. Right now with the gas fees, that's impossible, and that prevents global adoption. So these are the things I'd like to see, my little checklist. If we nailed all 5 of these, I would be 80% ETH. Thank you for the question. Next question from Corax G. In the hunt for non-KYC coins, is there a risk of having your Bitcoin blacklisted when using mixing services such as Samurai and Wasabi? So I think it's Samurai. Sorry, Samurai came out really bad. So first of all, there are risks as well. And I love these questions, but potential Bitcoin blacklisting is definitely possible. If you use a mixing service, the government is probably tracking you. They can track everything. If that mixing service is blacklisted, your Bitcoin might face the same fate. This could hinder your ability to use it for transactions. Now, if it's mixed properly and well enough, it might be impossible to trace. Who knows? But the other thing to be concerned of is you getting blacklisted. If they track your VPN and they see who you are and what you're doing, they might file something against you. Again, you don't want the authorities on your back ever. That's something I would never want anyway. Scam potential. Also, there are numerous scams out there that are associated with mixing services. So be careful. You know, it takes a lifetime to build up wealth and a second to lose it. I say that all the time. But your Bitcoin could be taken with any chance of recovery. So using these things is very dangerous. And finally, illegal activity association. You know, utilizing a mixing service linked to illegal activities may attract authority scrutiny, potentially leading to an investigation. And there are even coders on mixing services that were thrown in jail. So, you know, I like to avoid risk, including authority risk, jail risk, losing stuff risk. So be very careful out there, and I would not recommend it. Also, remember, people say, can the government confiscate Bitcoin? Oh, hell yeah. Well, there was an executive order 6102 issued in 1933 that really made it illegal for individuals to hoard gold coins, hold bullion or certificates, and require them to turn their gold over to the Federal Reserve at a very fixed price. Can you imagine if that happened to Bitcoin? Yeah, we'll give you $10 a Bitcoin, no problem. So can the government do things? Yes, they can. So stay on the right side of the government. In addition, as we always state here, not your keys, not your coins. There are people that hand over their Bitcoin to trusted companies, that hand over your Bitcoin to trusts, and then the trusts gamble it away on NFTs and crap like that. It's just the best way, and that's why I've done so many wallet videos. In fact, it's the only video in a month where I haven't done a wallet video, is Bitcoin personal storage on your cold wallet is best. Learn how to do it. Do it. I have a whole playlist, 50 videos on how to do that safely and effectively. Next question from Blue Tiger. Will Tesla ever sublicense FSD to other EV makers and ultimately become a software AI company? As an aside from cars and robots, where else do you imagine FSD could be applied? So it's quite a great question. Let me just throw out one of my little mind maps here to give you an idea of, first of all, what they could do. I'm going to walk through where their flywheel is and how it is a force to be reckoned with. And remember, a flywheel refers to the interconnected and mutually reinforcing aspects of a business, in this case, Tesla's business model and product ecosystem. And it revolves around several key components that work together to enhance Tesla's competitive advantage and drive its growth. And these are some of the elements that I see in their flywheel. First, manufacturing process. They build stuff like nobody else. Second, car and thunk. When I first 5 years ago got my Tesla X, everything was different and it blew my mind. Third, battery technology. Fourth, as you mentioned, FSD. Fifth, energy storage, which is Megapack. 6, solar. 7, hidden, Optimus, their robot. We'll talk more about Optimus later when we talk about GDP, by the way. Then we have HVAC. They've got special octavalves that are very good for heating and cooling. You got your Dojo supercomputer. That's another element of business that could be leased out. Their whole Dojo, which is going to scale infinitely as we go forward. Robotaxi business, insurance business, superchargers, and on and on. But what's special about these things is they all support each other. They're all built with this integrated vision and strategy. No other company, none on earth think like Tesla. That's why I'm obsessed. And I'm so glad I have influenced tens of thousands of people to buy Tesla. When I was doing videos every second day, all the crypto people were saying, stop making Tesla videos. You're an Elon lover. Ugh. Anyway, it paid off extremely well, ladies and gentlemen. So unlocking full self-driving is, first of all, there are 3 elements to doing this. One is their Dojo supercomputer, which has been running for about a couple of months now. Second is their neural net. And third is testing edge cases. And they have over 1 billion plus user miles to do this. There is, again, no other company that has these 3 ingredients to nail FSD. I have FSD. I've been a beta user for a long time now. It gets better every single week. In fact, they're releasing new updates every 5 days, it was never happened in the past. So back to your original question. Are they going to do it? Yes, because the money is not in making cars. If you make software, zero variable cost and infinite margins. Basically, it's margins to infinity. Let me explain how. Elon Musk has said that the margins for Tesla FSD software will go to infinity as the technology improves. And this is simply because the cost of developing and maintaining the software will eventually be outweighed by the revenue generated from selling it. That's an understatement, by the way. And currently, the cost of FSD is $15K. But as the software becomes more capable, Tesla will be able to charge a lot more for it. In fact, Elon Musk has said many times, even selling at $15,000 is stupidly cheap for what it generates in terms of value. So imagine you have an FSD car that can eventually drive a car from, say, Los Angeles to New York without any human intervention, or San Francisco to LA, or Chicago to, I don't know, Texas. Tesla could charge a significant premium for the software. This could also include things like transportation trucks, moving furniture across the country. Instead of paying for drivers, it could just be a whole, what do they call, trucks back-to-back, convoy of trucks following each other. One using FSD, the rest just following each other with the radar. I don't know. But this is where margins go to infinity. And yes, you're right. This is the play. Not only the application of FSD and licensing it out to other car companies which are not capable of making it. In fact, they can't even make batteries. But so much other stuff as well. And licensing that will be mind-blowing. But also integrating FSD into robots. And this goes back to the Flywheel and how everything supports each other. Again, it's the most mind-blowing company of my lifetime by far. And I've been watching Disruption for 30 years. Next question is from Mighty Mike in Miami. You told us not to sell assets such as Tesla, but rather hedge, saying that selling 6 to 12 weeks out of the money calls is a good strategy for you. When Tesla was in 275 range, that is what I would have liked to do. Can you teach us tools and what to look for to analyze which are the most favorite calls to sell and puts, how to play it? So, big one today. First of all, let's look at kind of the process that I walk through. I'll let you know inside my mind, because I was so tempted. I saw this thing running out of gas at 275, 276, like everybody else. And I thought, oh, should I flip it back to Bitcoin or hold or hedge, or what was I going to do? Well, first of all, I looked at the layers. You can see here, layer 2 is exactly what it hit. And typically, when it hits a layer, especially after a large run like it had, it will mean revert. This is the IA layer out model, by the way, if people are asking. After that is layer 3, which goes up to about, I think I can't read the small numbers here, 302, layer 3. So the difference in width between kind of the 276 to 302 is a very, very small amount. And I have experience where, again, rampages can happen. We saw what happened with NVIDIA, just up $100 overnight. So that's step 1. Step 2, I use IADSS to confirm, and it did. You can see a couple of things here. Obviously, the buy signal originally, hey Jim, and then double sell signals at the top, also supported by the mean reversion trending down, and the trend turning orange. Boom, boom, boom. Perfect. 3 of them. You take these 3 items, you add up the confluence of, say, 85%, 80%, 78%. That means you're 95% sure when these 3 things say the same thing, price will go down, and the vice versa when it's the other way around. So that all said, yeah, do it. But then step 3, this is very important. What stopped me was kind of the Cybertruck news, Q2 earnings, FSD progress, the AI narrative, the fact that stock market and analysts are beginning to wake up to what Tesla actually is because they think it's a car company still. They don't understand that flywheel I spoke about. And that is the big issue. In fact, and the other thing as well, I think Q2 earnings will be really good because Europe has blown out the numbers compared to last year. The adoption is insane. We don't have US numbers yet, but I think there could be a big surprise. Also, I think there could be a big uptick in FSD licensing and mega pack deals. The question is how much of that revenue is actually accrued during the quarter. But either way, that's good. The other thing as well, let me take you way back in time to this chart here, ladies and gentlemen. This is basically year-end 29 to about October 2020. All right? Beware of this. This is what I call a rampage. This is when Tesla went up 3,500%. 35x in a pretty short window of time. You don't want to be on the wrong end of this because did it ever come back to this level? Nope, not at all. And that's what I'm very afraid of. I don't mind short-term undulations. Yeah, it might go from 276 to 254, 250, who cares? Maybe 240. 240 is when I probably buy again based on the layers, etc. But here, I just, it's not worth it. There are certain things I don't mind being called out of and leaving, but certain things I want to keep long-term because of what it is. And this is why I'm extra cautious. So hope that helps in your analysis. And by the way, I do hedge my MicroStrategy. I hedge things like my Meta, all that type of stuff. I'm now out of NVIDIA, as I mentioned on Patreon last week, completely out. But I will re-enter when the time is right, if the price is right. So next question is from Histepa1. I went in heavy and bought shares of Tesla in the beginning of the year when you were pounding the table on it. Yay. I bought more when it pulled back several months ago. I don't need the money and I'm long Tesla, but I'm also up 85%. I'm not sure if I should take some money off the table. So let's look at a couple of things. One, this is the end game for me for Tesla. My bear case is a stock price of 3,500. Okay, by the year 2030 to 2032. That should be not 2023, it should be 2030 to 2032. Slight typo there. So you have an asset now you can buy for 250. In the next 8 to 10 years, it's going to 3,500. No ifs, ands, or buts. You can bookmark this video and record this. That is my bear case, and I have analyzed it 8 ways to Sunday since 2017. Now, if you do need to take some profits, there are layers. Remember the layers, you can sell, let's say, at 276 and buy back in at 250 or whatever else. But these are some of the layers that I see right now. So 251, 239, 225, 201. You could play around with those if you do need to take. But again, for as far as I'm concerned, it's a keeper. It's like Bitcoin is kind of a keeper, unless, of course, I can find something better at a cheaper price, then I'll flip Bitcoin into that asset, which I did with Tesla. Much to the dismay of many people out there. Anywho, next question, Gene. Who would buy a deep in the money call option from me and why? If somebody wants the stock, they could outright buy it rather than going via an in the money option. If they expect further upside on the option's profit calculator is showing me the percentage profit will be the same for an option that's just in the money. And an option that's deep in the money just goes up with the stock. I'm wondering about liquidity if I hold a leap until it's too deep in the money. Well, you're looking at somebody who's been holding leaps his entire life, especially on disruptive stocks. And when they do things like stock splits, etc., they're always liquid. As long as you have a name. The only time I've ever had a challenge selling large blocks of like 3-digit plus contracts was CleanSpark. It took me weeks to get fills on those, but eventually I did. So it can happen. But liquidity for assets like this, not a problem. Let me explain who would buy a deep in the money call option and why. First of all, every asset has a price, as I started the show with. And the speculators, for example, buy deep in the money calls to profit from anticipated price increases in the underlying asset. And they can also participate in the potential upside with a limited upfront investment. but depends. That you're dead right. If something is, say, more than 50% in the money, it can get a little bit crazy. But sometimes some people don't have access to margin to buy stock straight, so they have to buy options. Also, investors seeking leverage can use deep in the money options to control a larger position. For example, if they're afraid of a 50% downturn, they can sell an in the money position against their long position. And this leverage allows them to amplify potential returns, and we love to amplify returns here. Also, hedgers use deep in the money call options to mitigate the risks associated with their existing positions in the market, and these options can act as an insurance policy. And finally, arbitrageurs exploit price inefficiencies. It's a big part of my game too, between different markets and related assets. They can, for example, what I like to do a lot is scan for mispriced deep in the money call options, take advantage of price discrepancies and attempt to profit by simultaneously selling the underlying asset or similar options to capture the price differential. So there's lots of fun you can have, and hope that answers your question. But let's look at one real one, for example, which I actually have some of. This is a deep in the money call option on Tesla. Strike is $100, goes out to January 2025. And even though the stock price, like if you look at the pure intrinsic value of this option, is about 156, it's selling for 168. So you got that extra $13 worth of time value that's embedded in this option. Obviously, the less intrinsic value you have, the more time value you have, the more volatility, etc. But again, this can be sold tomorrow, and you can watch these yourself. You can look at the daily trading volume of these and how close they are, and you can calculate your IV versus time value all the time too. So thank you for the question, Gene. Next question is from Vic. I saw a tweet from Toly about the Supervolt and mSol. Looks interesting. Could you provide some feedback and analysis? Again, thank you for bringing this to my attention. I wasn't sure. I'm going to do a very short view, but it probably does require a lot more work. So first of all, there's a thing now called Supervolt mechanism, and this is the mSol Supervolt, and it leverages recursive borrowing and lending of mSol and Sol to amplify yields for mSol. Now, this has been done on other chains in the past, but this one is a little bit interesting. So, for example, users can deposit mSol into a vault, earn up to 15% yield, compared to 6.5% when deposited mSol alone. And deposited mSol is used to borrow Sol, convert it to mSol, and restake it, effectively multiplying the yield. Okay, following me so far? A visual of this looks kind of like this. Supervolt, swap your Sol for mSol. Other people borrow Sol, and then the Drift has that lending program. It's not unlike what happens in other DeFi protocols out there, but this is very Sol specific and mSol. There's also the Drift protocol, which you saw in the graphic there. It is open sourced DeFi protocol on Solana. It allows staking assets as collateral to borrow other assets, such as depositing USDC to borrow Sol. And the yield source, this is important. Yields in the Supervolt come from the implied appreciation of mSol compared to Sol minus borrowing costs on Drift. So it sounds like a dream, but remember, there's a lot of risks with this type of stuff too. So just to highlight the risks, you have depeg risk, i.e. there's a risk of mSol deviating from the Sol price. That could trigger liquidations if a depeg occurs. We all know about depegs. Even Tether depegged a couple of weeks ago by the tune of a few pennies. Mr. Hammer, thank you so much. Liquidity risk. Extreme depegging could affect liquidity, make it challenging to liquidate mSol positions swiftly. And then you got your smart contract and user interface risk even. As with any DeFi product, there can be vulnerabilities in smart contracts, or an operator error can result in unexpected behavior or a loss of funds. And finally, liquidation risk. Leverage staking carries a risk of liquidation if a margins ratio becomes unstable, leading to the sale of collateral. We've seen in other DeFi protocols, sometimes they depeg kind of on purpose to wipe people out, and then it bounces right back. Beware of that. Always be paranoid. And finally, oracle risk. The Supervolt relies on external oracles for price data. And if they screw up, if they ship in incorrect data into the actual platform, it could result, again, in more liquidations and substantial losses. So again, there's no such thing as a free lunch, ladies and gentlemen. You can play with this with a very small percentage of your bag, but do not put your whole bag there. Next question. I love chicken rice. I loved your retire on Tesla video as it gives me a target to work towards. That's exactly why I do these, everybody. I'm so glad you said that. The key to retiring is to have a plan. When I was 30 years of age, my father died. I made a plan. I said, I'm going to retire by 50. That was it. It was the simplest one-liner plan in the world. But I worked towards that every single day, obsessed with it. And I executed as well. So having a plan is why I do these. So people have a target that they can work towards and figure out how they get there. And again, my price predictions, predicting things, 8 years out is very, very difficult, but at least it gives you a plan. And as long as you have a number of these retire on videos with a number of assets, you can chip away. And I guarantee you, you will do well in the future. But you want what I call a cocktail. What non-crypto related stocks are good to add at a current price to complement a heavy Tesla equity portfolio? Should it be a 60%, 30%, 10% weightage? So I'm working on exactly that right now. I call it the new retire on cocktail. It's been impacted by a couple of things, not only in the crypto world, but also in the equity world. So there is a delay due to the SEC, and there's a delay due to the AI Rampage for equities, because it's hard. I like to do these when the prices are kind of good, but not when the prices are extraordinary right now. But I am working on both a cocktail for crypto and a cocktail for equities, and maybe after that a cocktail of both, which will also include some real estate. So that's coming, just haven't nailed the perfect cocktail yet. Allocations do matter. Next question is from Loose Change. So we are looking for our first home with the idea of locking in the purchase price now and refinancing 18 to 24 months once, if rates come back down. Would this be the best play to get on the real estate ladder in the current market? And any pitfalls to avoid with this plan? So I know we have some real estate professionals in the audience, and this is so exciting. Let's look at one market. I just picked up a random market because a friend is moving there. This is in a place called Charlotte, North Carolina. And this is a house. This went to Zillow, literally popped up Zillow, searched 4-bedroom house. This is the very first one that came up. So I hope nobody in the audience lives here because I'm exposing you. But anyway, the point is a 2,600 square foot house. It has gone up 15% in the last 8 weeks. And you can see actually the growth rate from kind of 2017 to today. It was 190K, 180K, 160K. Now it's nearly $500,000. That's in a short window of time. So the point of this is this, and I will share this model later on Patreon. This is my real estate model for Patreon's coming. It'll be finished this afternoon. Now, what you have here is a couple of things. It shows you all of your typical costs. I assume we buy this house. I assume we put 20% down, which is $98,000. When you have this model, you can plug in any numbers you want yourself. Closing costs, I assume they're zero because I don't know what closing costs are in the state of North Carolina or Texas or New York, etc. I forget the other stuff. Rental income, you can play with that if you want to buy it as an investment property. But then what I did was, this is the most important part. So property taxes, maintenance, utilities all remain the same. But I did toggle the interest rates for borrowing this, a 30-year fixed. If you have certain benefits, there are some 30-year fixed you can get for 6.5% today. And they were as low as 2.75% not too long ago. The point of this, and these numbers might be off, it might be 3% versus 7% or whatever, it doesn't matter. But the point I want to make to you all, this is the money here. The property appreciation over the last 2 months is $74,000, okay? The monthly difference in the cost of the mortgage from 2.75% to 6.5% is only $877 a month on $500,000 property with 20% down. That is exactly $10,000 a year, okay? So the point is, you buy an asset on leverage, real estate, 20% down, 80% is funded. Your mortgage interest is tax write-offable. By the way, I've got tax write-off details on the bottom of this model below. You can check it out later. And you can make $74,000 in 2 months. versus 10,000 extra interest payments over the year. So the thing is, right now, when you see a dip in prices, jump on the property ladder, refinance in 2 years or less, because rates will come down. Rates have to come down. The Fed can't sustain these rates forever. The amount of interest on debt that the US has exceeds GDP growth. We'll talk more about that in a minute. So again, here's a simple little example. Run the models yourself in your own zip code. Look at different houses. If you want it as an investment property, check out the rental income rates, etc. See if you can make this thing cash flow. Always take into account things like property taxes, utilities, HOA, closing costs. Very, very important. But here, the net message is, don't delay getting on the property ladder if you don't have your castle. Not financial advice. And ask some of the real estate professionals here in the audience, and I see them. Next question. This is one which was brilliant. Another mind expander from Rubik Alex, of course. I used to play with Rubik's Cubes as a kid, so I love that name. But here, assuming the sky is the limit, what would it take for the US to reverse the negative debt to GDP ratio direction? So, for example, should GDP grow by 40%? So I went one further and I tried to think, okay, imagine I'm in control and I've got to bring debt down to zero for the US, and I've got to do it for 10 years. And at the same time, debt will be expanding by 14% per year, which is kind of typical monetary debasement. Here is the formula, which is kind of stunning. So debt to GDP ratio, T plus 1. I said 10 years. And you can plug in any numbers yourself whenever you want later in a spreadsheet. But the point here is to reduce the debt to GDP ratio to 1%. I didn't do 0. Took it down to 1%, which is effectively 0 from where it is today, 130% debt to GDP ratio. And I have to do it in 10 years. While the debt is growing by 14% per year, the US economy would need to grow at a rate of approximately 91.1% per year for the next 10 years. Basically, it would need to double for a decade. Is that possible? Let's look at a visual of how extreme this looks. And that's why once debt to GDP goes above exactly 77%, it's beyond the tipping point. You can never get back without what they call a great reset. Let's look at this little chart here. So the GDP today is 20.25 trillion. It would have to double to 38.68, and then double again to 73, double again to 141, double again to 269, up to, what is that, $3,600 trillion. Again, it's outrageous. It can't happen. But also, as I've shared many times, the debt is going to explode from here. So is what I call money printing acceleration. It's going to explode from here. That's why you need things like this to protect yourself, ladies and gentlemen. That's why I'm here doing this for you all. So it's staggering the time of our lives we're going into. We have exponential assets, like crypto. We have exponential companies like Tesla. We have AI coming to the fore. There is one way that this could be alleviated. It'll never be solved. You never get back to zero. But we do know we don't have population growth to support GDP growth. The only way for us to get there is things like AI and robots. And that's where people are taking us, like Elon Musk. So on that final note, quick reminder, DCA tomorrow morning, 7:30 a.m. Pacific, 4:30 Central European time, with our two friends from Sweden, Ivan and CTO Larson. And it'll be a very interesting event. And by the way, if you have something that's a burning question, drop it in the comment below. I look at them all. And thank you as well for the help with animals. This is Lobo. It's a wolf dog. And this week we donated to Wild Spirit Wolf Sanctuary to help support food, shelter, medical, etc. Playful. Lobo is, by the way, playful, intelligent, curious, timid, and sweet. Lobo loves his best friend Flicker, and he likes eating oranges. That was new to me, by the way. I've never seen a wolf that eats oranges, but wolves are not dangerous. They're man's best friend, just like dogs. So thank you, everybody. That was the live Q&A. Covered a lot of ground, a lot of topics, but it was, as I say, absolute mind expander for me too. You guys and gals make me think in so many different dimensions. So with that, I'll open up to some questions too. And thank you to the mods in the chat, Kiwi Robin and T&D Tells and everybody. Shout out to K8 working hard for us every day. Yes, thank you so much as well. Jim Manley, I'm in big on Tesla stock and covered calls because I discovered KPM. Been good, thanks. Yeah, but be careful, Jim. Don't get called out. People have this weird thing that I mentioned at the beginning. I'll reiterate again because so many people are like, oh, I'm up 85% and they'll sell a call. And then they'll lose their underlying asset if they don't roll up. And you may never be able to get back in on these prices. Also, there is cost when you do sell these things and incur capital gains, taxes and headaches. So just be careful with the cover calls. Make sure they're on a spike. Make sure you cover them quick. Watch the layers. So important. Mike G, would I be safe if I moved to cash in iTrust? I have plenty of GBDC and iTrust was my Bitcoin and Sol exposure. Yeah, I don't know a lot about iTrust. I do know they were with Prime Trust. I read anecdotal stories that they moved to Fortress Trust, which is apparently also allegedly run by the same people that run Prime Trust. And also they may not be licensed. I just see way too much hair and warts and all this stuff. Again, it takes a lifetime to make it, a second to lose it. Be very careful. You'd have to check their articles if they are FDIC insured. If they are, up to 250K of cash is covered, but odds are they may not be, but check on the fine print. I don't know offhand. I don't, as I said many times before, I'm not into IRAs and 401ks and stuff like that because I never thought I'd live that long. And I had different plans, so that's just me. But I haven't actually looked at iTrust, but just do remember, again, like we mentioned as well at the beginning, people were storing crypto, not themselves, but handing it over to somebody else that in turn handed over the keys to somebody else. I won't mention all the names, but in Patreon, you saw many of my 3 big long dissertations on that topic in the last few days. So MT, thank you so much for being here. Walking the dog. Happy Sunday, walking the dog. I hope you have a wolf dog. This is from William Barbier. James, ETH weekly dominance is currently in the ascendant wedge towards 20%. Do you expect a breakout in the coming months, and at which level? So yeah, let me just pull up not the ETH dominance, but I did notice today that alts and some of the pairs I look at were doing better than, let's pull this up live if I can. Hang on. I gotta fire up my trading view. Got too many pairs. ETH, Bitcoin, where are you? There you are. Yeah, 0.06. Let's zoom out, look at the year-to-date chart and have a look as to where we are. This will be funny. Boom. There it is. So we see here, I'll kill this, move that away. This is kind of the chart. I just want to show a couple of things. One is we were in that channel. It smashed through the floor. A lot of that was due to the BlackRock Bitcoin ETF news. But when we zoom in, you look at that nice little bounce right here at the 0.06. I think, yes, definitely see it going back to 0.07 and even higher from the chart here. So from that perspective, this is a beautiful entry to even swap Bitcoin to ETH. I actually did something in full disclosure, which I've never done before. I swapped Bitcoin to ETHE because of the 53% discount. So that's another way to kind of play it too. So hope that helps a little bit. Just looking at that. So yeah, that looks like a good bounce, a good pop. I'm not into the whole wedges and bear flags and bull flags. I rather look at things that are a combination of those. And it does look very positive with him. CMG, I'm so sick of waiting for Bitcoin to hit 100K. When would 100K? Oh my God. Yeah, we had a very, it was a very rough summer, but it was also a very great time to accumulate. Sub 20K Bitcoin, truckloads of it, and get into proxies real cheap, which have been doing very well. When 100K, my target, I do believe we could easily get somewhere easily between 35 and 42K by April 2022, which is not an extraordinary move from here, but it's big enough. When 100K, I think by September 2025, we should definitely, at the very least, be above 69K. And again, it's not a big stretch to go all the way up to 142K, where I see some of the layers going. So when, I don't know, sometime between, hopefully, barring any mess up, market manipulations, black swans, etc., I think we could get there before September 2025. And that is not too long away. Well, long enough. So, but, you know, in the investment game, slow and steady wins the race as well. If you put yourself under pressure to get rich quick, or things bounce from 20K to 100K, you're setting yourself up for disappointment and failure, everybody. This is a marathon. It's not a sprint. So, but I assume it's also a very good joke too. And I thank you for your super sticks as well. Andy, AC1, Tesla Bull Believer, Silicon Valley Stoic, Q Robin, Viciously, Investing KO, Gaffellow, KN, Adam Q, Jeff Hammer, and P. Dot. Appreciate you all. Thanks all. Good night. See you tomorrow morning for DCA on my channel. And thank you for the 2,000 lovely people watching live. And thank you all for the support and the likes and the donations, where we try to make the world a little bit better every single day. So thanks all. See you tomorrow. Bye.